Die Sprachübertragung beginnt jetzt. Alle Teilnehmer befinden sich im Zuhörermodus.
Good afternoon, ladies and gentlemen, or let's say a very good morning to our listeners and participants in the United States. My name is Philipp Bunnenberg, and I am happy to welcome you to today's BAI webinar, Timberland and Farmland, Alternative and Sustainable Investment Choices. So, as you probably know, over the past few months, we have been highlighting nearly all alternative asset classes and strategies, of course, given the fact that the COVID pandemic had and still has a major impact on all these markets. So you're, of course, welcome to rewatch most of these webinars on our website or our YouTube channel. But back to today's topic. Roland, okay, here's the mouse. So here we go. So farmland and timberland was recently a subject at our yearly alternative investor conference. So maybe a few of you participated, and there it became more or less clear among investors with an affinity for alternative investments that the majority has not yet invested in these more, let's say, of a niche asset class. So nevertheless, I'm glad that we can make our contribution to education about timberland and farmland investments with today's webinar. So, as you can see in my slide here, there must have been some drastic changes in the market if even, German leading media writes about the timber price development. It's quite rare, I guess. And so we observed the rapid increase in timber price with significant influence on secondary on other markets. So such as the house price in the United States. So before the price of timber dropped again in the last few weeks. So I'm very pleased that we have two experts here with us today who can explain these and other developments to our audience better than I can. So a very good morning to Balter and Michael Strzelecki, who are both located in Boston, United States, and represent Hancock Natural Resources Group, a Manulife Investment management company. So Keith is managing director and head of economic research, responsible for the market analysis supporting investment and operational planning and decision making. Michael is managing director and senior portfolio manager and responsible for business development activities. The webinar will be recorded, and you can rewatch the webinar later on, as well as the presentation slides will be made available for you after the web. And of course, there may occur questions during the webinar, so feel free to ask the questions. We will have a short Q&A session following. So now I give the floor to Michael. Dear listeners, enjoy.
Great, thank you, Philip. It's a really great pleasure to be with you here today and with the broader BAI community to introduce the timberland and farmland asset classes. Many thanks also to all the participants for attending today. I'll begin with a brief overview of HNRG, which is, as you mentioned, a Manulife Investment Management Company, and I'll discuss the general attributes of the timberland and farmland investments, as well as the sustainability benefits that these asset classes offer. I'll then turn it over to Keith Balter, who will discuss the performance of timberland and farmland during the COVID year, as well as our outlook for the future. Just trying to make sure I don't see it. Thank you. So HNRG is a leading manager of timberland and farmland investments with 14 billion in total assets under management and over 30 years of experience developing and sustainably managing core globally diversified portfolios on behalf of our investors. Sustainability and stewardship are really at the core of what we do and have been essential to maximizing value. We can jump to the next slide, please. In fact, when you manage the land-based assets such as we do, we would not be able to generate the strong results that we have over the long term. We did not manage them in a sustainable manner. 100% of our timberlands are certified to either the SFI or FSC standard. And we recently also just certified all of our U.S. agriculture investments to the new leading harvest standard. So why invest in timberland and farmland? Simply put, if we can go to the next slide, please, these asset classes provide real diversification benefits and generate positive impact. Sorry, if we can jump to one more, please. Both timberland and farmland have a long history of generating returns that are generally uncorrelated with traditional asset classes, and do so with low volatility that provides stability during periods of uncertainty and can enhance risk-adjusted returns for investor portfolios. I'm on the next slide, please. I don't seem
Just
to
one
have
question, Michael. Shall I go to do the slides for you?
Yeah, please. I don't seem to have control of the mouse, so I apologize.
Yeah, I will do it for you. Just say the next slide, please.
Thank you very much. Yes, so just mentioned here the general uncorrelated nature of the returns of timberland and farmland as compared to traditional asset classes, and the low volatility that adds stability to investor portfolios during periods of uncertainty like we saw last year during the COVID pandemic. Both asset classes also enjoy fundamentals that are supported by positive macro trends. Both create value over the long term, and both generate returns from a combination of income and capital appreciation. What's unique about timberland and farmland is that in addition to generating market rate returns and providing diversification benefits, these strategies can also have positive environmental and social impacts when managed sustainably. Next slide, please. I mentioned that timberland and farmland are generally uncorrelated to traditional asset classes, and here you can see the low or negative correlation with equities and fixed income. In addition to the diversification benefits that this provides, timberland and farmland have also historically exhibited positive correlation with inflation, which can help preserve value during periods of high inflation. And while there is a positive correlation between timberland and farmland, the lack of complete correlation between the two asset classes can provide additional benefits when both are included in a portfolio. Next slide, please. So I mentioned just earlier that these asset classes generate total returns that are comprised of both income and appreciation. Another thing that is unique about timberland and farmland as compared to other asset classes and even other real assets is that they generate return from biological assets. So income is mainly generated from the harvest and sale of the timber and agricultural crops, as well as other sources, which may include land lease income, carbon and renewable energy, and the sale of land for conservation or higher value uses. Capital appreciation is driven by changes in real prices and productivity, gains in land values, and the actual growth of the biological assets, whether it's a forest, an orchard, or vineyard. As the assets mature, this contributes to the capital appreciation. So these factors contribute to total expected returns of approximately 6 to 10% for timberland and row crops, and 9 to 11% for permanent crops on an unlevered basis. So when I talk about row crops versus permanent crops, you can think about row crops as corn, soybeans, and wheat, crops that are harvested and replanted annually, versus permanent crops such as almonds, wine grapes, or apples, for example, that are perennials. The higher expected return for permanent crops is a function of annual crop price exposure, assuming a direct operate model that results in higher volatility as compared to row crop investments where the land is typically leased and collects a steady rental income. Next slide, please. So taking a closer look now at historical returns, you can see that timberland and farmland have performed differently over time and have offset each other's periods of weakness under various economic and policy conditions. The chart shows returns for timberland, farmland, commercial real estate, and a hypothetical portfolio comprised 50-50 of timberland and farmland over 3 periods of time. First, 1976 through 1990, then 1991 through 2009, leading up to the global financial crisis. And then finally, the last decade from 2010 through 2020. In the first period shown there in green, timberland returned an average annual return of 15%. That was its strongest performance for all 3 periods, while farmland registered its lowest average returns during that time period. That included the 1980s farm crisis recession, while timberland returns benefited from increasing monetization of forest products companies' land holdings, booming log exports to Japan, and a cyclical peak in the US housing market. In the decade and a half leading up to the GFC, shown there in blue, timberland and farmland posted moderate average annual returns of 12 and 11% respectively. In the wake of the GFC since 2009, shown there in orange, timberland returns dropped sharply to an average return of about 4%, reflecting really a historic collapse in US residential construction activity, as well as what's been an exceptionally lackluster housing recovery in the post-GFC period. However, during the same time period, farmland returns were exceptionally strong following the GFC, increasing on average 10% annually and showing limited vulnerability to the global economic slowdown. As a result, the hypothetical portfolio consisting of 50% timberland and 50% farmland would have delivered a more consistent performance over the long term, somewhere in the range of 7 to 11%, with an average of about 9.5% across these different periods of time. You can move to the next one, please. So switching now to the investable universe, each of timberland and farmland are relatively small as compared to traditional asset classes, with timberland estimated at just under 350 billion and farmland at about 1.9 trillion dollars. The timberland investable universe is dominated by the US, which represents approximately 2/3 of the total. And of that, the US South represents about 2/3 of the US. So there's a heavy weighting to the US South overall in the investable universe. And that weighting is the main driver of what's been lackluster benchmark returns over the last decade, given an oversupply of saw timber in the US South region. That's changing now, and Keith Balter will talk more about that later. Other key investment geographies for timberland include Chile, Brazil, and Uruguay within South America, as well as Australia and New Zealand. Europe rounds out the investable universe with about 8% of the total. Now, in comparison, the investable universe for farmland is more than 5 times larger than that of timberland, and the US represents a smaller portion. So together, the US and Western Europe represent about 55% of the total investable universe for farmland. When you add in Brazil, that gets you to about 3/4, and then Canada, Australasia, Eastern Europe, and other South American countries round out the total. So combining the 2 asset classes in a portfolio has the benefit of increasing the investable universe overall, and then as well as the flexibility to invest capital, as both of these asset classes have relatively uneven opportunity flows. In addition to increasing the investable universe, combining both timberland and farmland into a single strategy has the ability to provide stability of returns, as I mentioned just earlier. And furthermore, differences in end markets, which are uncorrelated, also provides additional diversification, which can reduce volatility of the overall portfolio performance. We can shift now to the risks. And as with the drivers of return, you can go next slide, please. As with drivers of the return, there are unique risks that are specific to timberland and farmland, which investors must be aware of when entering these asset classes. So crop prices and harvest volume drive the majority of return and therefore the majority of risk as well. In addition, there are water and weather-related risks that also need to be considered with these asset classes. HNRG seeks to mitigate these risks by developing portfolios diversified by region, crop type, and end markets. We also conduct extensive due diligence on investment opportunities, and once we have properties under management, we employ active forest and farm management practices. So we cannot completely eliminate these risks, but our approach has been successful in significantly mitigating these risks. Next slide, please. I'll turn now to the sustainability aspects of timberland and farmland. Investments in these asset classes can create positive and environmental impacts, positive social and environmental impacts, excuse me. In particular, the commercial production of timber and agriculture commodities on sustainably managed properties contributes to several sustainable development goals. I'll briefly touch on these and provide some real-world tangible examples. So the first is SDG 2, Zero Hunger. Sustainable agriculture is essential for feeding a growing global population that's expected to reach almost 10 billion by 2050. Healthy foods like nuts, fruits, and vegetables meet basic human needs. In order to do this, food must be produced in ways that enhance rather than erode the natural environment through practices that improve soil health and sustainable agriculture practices. SDG 12, responsible consumption and production. Sustainable forestry produces saw timber, which is used in housing, and pulpwood used in paper and hygiene products. Since inception, HNRG forests have harvested enough saw logs to build about 2.3 million homes. And furthermore, building with timber in general can significantly reduce greenhouse gas emissions as compared to building with concrete or steel, because the trees are a carbon sink and timber is lighter and less emissions intensive to transport. SDG 6, clean water, is also very important. Forests play a critical role in preserving and enhancing water quality for downstream populations. Headwaters are often located in forested regions, so maintaining forest health through sustainable forestry can contribute to the provision of clean water. And for example, our forests protect about 20,000 miles of streamside frontage. SDG 8, decent work and economic growth. Both forests and farms are often located in rural areas, and the commercial operation of these investments can deliver significant economic benefits to these more isolated and less economically resilient communities. Institutional investors' access to capital can help accelerate the deployment of new technology, improve genetics and management regimes that will allow farmers and foresters to achieve higher yields while being more efficient with their use of water, fertilizer, and other inputs. SDG 15, Life on Land, sustainable forestry and farming can really help maintain and enhance biodiversity through conservation easements and maintaining buffer zones adjacent to water sources, and thereby preserving habitats that might otherwise be lost to future development. We have protected about 472,000 acres of sensitive land areas since inception. And last but certainly not least is SDG 13, climate action. Forest and farmland have the ability to capture CO2 and sequester significant amounts in trees and soils. Reforestation and sustainable agricultural practices are some of the most effective climate change mitigation strategies available right now. And responsible management of timberland and farmland will have an increasingly prominent role in mitigating and adapting to climate change. Over the past 5 years, HNRG managed forests and farms have removed an average of about 2.5 million tons of carbon dioxide from the atmosphere annually. And that, to put that in perspective, is equivalent to the electricity use of approximately 300,000 homes each year. We can move to the next slide, please. So the world is rapidly waking up to the dangers and risks posed by climate change and the environment. For serious and ambitious action to address climate change has really never been stronger across both the public and private sectors. On day one of the new Biden administration, the U.S. rejoined the Paris Climate Agreement and committed to review the previous administration's climate policies. Other pillars of the Biden administration's climate plans include protecting 30% of U.S. land and 30% of U.S. oceans by 2030. That compares to about 14% of the U.S. that's currently protected. Another is the commitment to shifting U.S. energy consumption to 100% clean energy, as well as indications that the U.S. Department of Agriculture will create a carbon bank to pay farmers for sequestering carbon in soil. And finally, a commitment to reducing emissions by at least 50% by 2030 based on 2005 levels. In the EU, leaders agreed last year to increase greenhouse gas reduction targets to 55% of 1990 levels by 2030, rather than 40% previously. And in 2019, the EU had endorsed a climate neutrality goal by 2050. And then finally, in China, the world's biggest source of carbon dioxide, responsible for about 28% of global emissions, the president stated an aim to have CO2 emissions peak by 2030 and achieve carbon neutrality before 2060. And this is the first long-term goal committed to by China. So that's the public sector. In the private sector, there's been an explosion in the last few years of corporate net zero commitments, joining an already robust landscape of climate alliances, disclosures, accounting standards, and reporting frameworks. In 2020 alone, we saw a tripling in the number of companies making net zero commitments, from about 500 in 2019 to more than 1,500 last year. According to the World Economic Forum and McKinsey, there's no clear path to deliver climate mitigation without investing in nature. And this makes sense, of course, because nature has been sequestering carbon dioxide efficiently for millions of years. It's estimated that natural climate solutions could provide up to 37% of the emissions reductions required by 2030 to keep global temperatures within safe limits. Next slide, please. So forestry and agriculture represent nearly 1/3 of the spectrum of strategies for carbon capture, and importantly, at the lowest cost. Forests alone offer over 2/3 of the cost-effective natural climate solutions mitigation needed to hold warming to below 2 degrees Celsius, and about half of the low-cost mitigation opportunities. Importantly, these solutions are available now at scale and with underlying economics that make them investable. So in summary, Timberland and Farmland provide investors with uncorrelated returns that can enhance risk-adjusted portfolio performance while also generating positive impact as natural climate solutions. Sustainable management practices support healthy ecosystems, which provide immense value to the vitality of communities, economies, and the environment. And investors in financial markets are in the early stages of attributing real value to these non-financial benefits of timberland and farmland. We expect that further scientific research in this area, combined with a growing understanding among investors about the benefits these asset classes offer as natural climate solutions, will unlock new sources of value that today remain unrealized. So with that, I'll turn it over to Keith for the discussion on recent performance and our outlook going forward. Keith?
Thank you, Mike. In my section of the presentation, I'm going to touch on the current economic environment to provide some background and context for what our view is on prospects for timber and agricultural commodity markets looking forward. Then I'm going to focus on the near-term prospects in the farmland sector, then shift over to timberland, and finally conclude with some longer-term trends that we see contributing to positive changes in the value associated with these timberland and farmland assets. So in looking at the economic backdrop, timberland and farmland were able to weather the COVID downturn relatively well compared to a number of other sectors, particularly those that were tied to travel, hospitality, and discretionary spending. And that really relates back to the fact that timberland and farmland values, as Mike mentioned, are really rest upon and are very closely tied to the production of goods that meet essential human needs, food and shelter. And because of that, are definitely relatively resilient in economic downturns. Now we're looking at the global economy emerging from the COVID pandemic, and commodity-oriented markets have been very active in this recovery period. And this has definitely been the case for forest products, timber, and the broad range of agricultural commodities. The U.S. economy has been enjoying a very stellar rebound with U.S. GDP growing at a 6.4% annual pace in the first quarter of 2021. And we're anticipating as second quarter GDP numbers are released, they're going to be even stronger. Last week, the U.S. Federal Reserve revised up their forecast for U.S. GDP growth in 2021 to a strong 7%. And really, you have to go back to 1982 and the days of Ronald Reagan to really sort of recapture growth rates in the U.S. At those levels. With the very successful vaccine program in the U.S., we've seen a sharp reduction in new cases of COVID, deaths, hospitalization, and the U.S. is starting to approach herd immunity. And this is supporting a rapid unwinding of restrictions on business operation and improved consumer confidence. Globally, COVID-related problem areas still are out there, like India, and they're presenting still major challenges. But the increasing availability and deployment of proven vaccines globally will support a broadening of global economic recovery over the next year. And the IMF is looking at global economic growth for 2021 to move up to 6% or higher. The rebound in the U.S. and world economy is manifesting itself now in rising inflation. Mike had mentioned earlier that when we look at farmland and timberland, you definitely see a positive correlation with inflation, and this is definitely the case now. U.S. headline consumer price index hit an annual rate of 4.1% in April, as illustrated in the chart here. And the Fed just bumped up its forecast for U.S. inflation for 2021 to 3.4%. These inflationary trends have manifested themselves strongly, both in timber and agricultural commodity prices this year. Next slide. On the farmland side, grain and oilseed prices surged in the first quarter, moving to multi-year highs. More recently, we've seen some easing in this price movements, and that really reflects expectations of increasing production, which has been triggered by these rising prices. The USDA latest report on planting showed increased acreage for most crops, and the weather this year has been very favorable for planting. So just in terms of expanded acreage, that's going to really sort of help to take pressure off of those tight markets. In addition, in Brazil, they're just finishing up a record soybean harvest, and that's moving into world markets and international trade in agricultural commodities. The top chart also shows the capital economics projections for soybean and corn prices, showing some correction going out through the remainder of 2021 into the first quarter of 22. So we're expecting some short-term easing in prices, but generally strong prices extending through 2022 based on the forward momentum we're seeing in the U.S. and global economy. Also, in terms of corn prices, there's going to be added support based on rebound in stronger ethanol demand, major market for corn. And that really reflects travel picking up post-COVID. And as the lower chart here shows, by March and April of this year, U.S. gasoline consumption was already back to pre-COVID levels and could be moving to new highs with expanded summer travel. Next slide. Thank you. Market fundamentals for ag commodities should remain favorable. As the markets rebalance after the severe COVID market dislocations, the recovering global economy will generate forward momentum and translate into rising income in developing and emerging economies. And this is going to enable further shifts to improved and more sophisticated diets. We do see some headwinds for agricultural markets, and those could be a result of maturing and slower growth in the Chinese economy and potential expanding agricultural production in developing economies, leading to increased international competition. Next slide. Timber markets are also riding on strong COVID-triggered tailwinds. U.S. residential construction activity staged a phenomenal recovery from the COVID downturn, and that's illustrated in the top chart. And that rebound was definitely boosted by changes in consumer demand, consumer behavior triggered by the COVID crisis. The shift to working from home, the lockdowns, which really increased focus on homes, really resulted in more desire, more demand for expanded and reconfigured living space. And that really sort of helped really push that demand for new residential construction and for repair and remodeling to cyclical highs early in 2021. In recent months, though, we've seen residential construction really hit some bumps in the road, and that's been due to high prices and short supplies of building materials and labor in the U.S. Lumber and wood panel prices surged this year to record levels, and that's illustrated in the lower chart, which really shows average prices in those in the last points there, really getting to record levels and making headlines in the financial press. The movements that we saw in lumber and plywood really rivaled the price increases for Bitcoin that was experienced this year. And like Bitcoin, we've definitely seen in more recent weeks a retrenchment as market dynamics really came to bear, as demand eased and production for those products has begun to ramp up. So we've seen significant price corrections recently that have reversed about 40% of the run-up in prices experienced by lumber and wood panels. Nonetheless, the extremely strong profitability that the sector has enjoyed over the past year is now really triggering a wave of new investment in lumber mills and in wood panel plants. A major Western Canadian wood products company, Interfor, recently purchased 4 U.S. lumber mills from Georgia Pacific and announced their intentions of investing in an expanded production at these facilities. Canfor, another Canadian lumber producer, just announced a very large new greenfield lumber project that they'll be constructing in Louisiana. These strong fundamentals in housing and wood products are starting to positively impact timber markets, but the improvements in timber values to date have been more delayed, more muted, and less volatile than what's been experienced for lumber and wood panels. And it has also been highly dependent on a regional basis, depending on that regional timber supply and availability. Next slide. In the remainder of the 2020s, we see continuing strong fundamentals for timber products and for timber values. And this is based on a continued upward trend in U.S. residential construction, as illustrated in that chart. And some key factors that are going to be supporting and driving further expansion in terms of residential construction activity in the U.S. are demographics and tight supplies of housing. Next slide. The largest cohort in the U.S. population, and this is illustrated in the top chart, is just entering their 30s. And this is really just entering the housing market. And this represents a real sort of fundamental support for housing over the coming decade. Also, another factor that's going to be supporting housing in the 2020s is the fact that entering this period as we come out of the COVID recession, there's a serious accumulated deficit in housing stock in the U.S. We've just experienced over a decade and a half of underbuilding, and in the U.S., supplies of housing are extremely tight. That accumulated deficit in housing has been estimated between 2.5 to 4 million units. And also, over the next few years, we're going to be seeing support from the Biden administration, who has signaled their commitment to supporting improvements in the U.S. housing stock and increasing access to home ownership. Next slide. And in the medium and longer term, we also feel that there's a number of trends that have the potential to offer additional upside to the outlook for timberland and farmland. We've already discussed the global economic expansion and the strong outlook for U.S. residential construction. But the role of these asset classes as natural climate solutions, as Mike pointed out and discussed in his remarks, is also likely to contribute to a value uplift for timberland and farmland. The strong attention of the Biden administration on forcefully addressing climate change bodes well for the development of carbon opportunities on timber and farmland based on the ability of forests, farmland soils, and wood products to capture and sequester CO2. So with that, I'll conclude my remarks on the market outlook. Thank you for your attention, and turn it back for questions. Thank you. Philip?
Thank you very much, Keith. Thank you, Michael. Thanks for the interesting discussion. I noted a few questions. So first, are there structures that allow for carbon credits to be distributed to investors?
Are there investment structures that allow carbon credits to be distributed to investors?
Yeah.
I think this is an area of the investment landscape for timberland and agriculture that is really emerging at this stage. I think there are a number of strategies out there that are sort of early days, and the details of how the carbon credits are actually distributed is still being developed. But I think that the key point here is that this is an emerging trend, and one that I think we see a lot of opportunity in, something that we are evaluating ourselves. And it appears to be one that has a lot of potential and long legs sort of for the next evolution of the asset classes here for both timber and farmland as natural climate solutions.
Thanks, Michael. The next question also relates to the natural climate solution you talked about. So maybe let's turn the table. What are the physical risks for farmland and timberland, and shouldn't these risks rise with ongoing climate change?
Go ahead, Keith.
Oh, Keith, please.
Yeah, I would say that yes, there are associated risks, but there is, and they really sort of differ depending on, particularly depending on geographic location. In fact, when you look at sort of climate risks and opportunities for farmland, there's definitely sort of based on geography, based on crop type, would it be winners and losers? For example, when you look at areas like in the northern latitudes, like Canada, you're actually seeing, as you look at different areas in Canada and northern Canada, you're seeing lengthening growing seasons and increased optionality in terms of the sort of crops that can be planted. So that you're looking at right now in areas like Alberta, shifts from growing, canola, and now having the ability to really move to higher value, higher yield crops like corn. In terms of timberland, you definitely also see that same sort of change. In timberland in general, the climate risks, because the growing cycle in trees are longer, they tend to have evolved to basically have that resilience to, changes and cycles and climates over those longer periods of time. You tend to have resiliency, but you also, again, have the ability to shift your management regimes. You have the ability to shift the species that you're planting over those longer periods of time, those 20 or longer year growing cycles, to adapt to those changes. So yes, there are risks there, but those are things that are being confronted, identified, and adapted to through management, through technology, through genetics.
Thank you, Keith. Maybe we can just keep the focus on the risk profile. Can you please elaborate on the special agency risks and maybe also political risks relating to these those institutional ownership of farmland and also timberland? So because it's probably a bit different in the United States compared to Europe.
In terms of this is limits on institutional ownership.
I'm not quite sure on which is the on which topic the question is relating, but it's just saying special agency risks and political risks in America compared to Europe.
Well, I mean, there are, in terms of farmland, you do have definite on either, well, looking at, say, Canada and the United States, you do have regulations at state levels. Some states do have restrictions on institutional ownership of farmland. And that really relates to the fact of, favoring, private small farmer ownerships. So you do have restrictions. You do have also restrictions in terms of access for institutional owners of farmland for some of the government programs, price support programs, crop insurance programs. One of the sort of strategies that we have used to address that is ownership of land, but actual like leasing the land primarily with row crops to private owners who have access to those programs. I hope that sort of addresses that question, Philip.
Thanks, Keith. So the last question I can see is referring to academic research. So saying that both asset classes offer historically attractive Sharpe ratios in comparison to traditional investments. It's also what you show us, Michael. And is this attributable to maybe better risk profiles, or do we need different valuation methods? Or maybe the methods we are using not the best?
So I can take a first crack at that, and then Keith can jump in as he's the co-author of the research on this subject matter. I think the historical Sharpe ratios reflect a number of things, and probably one of the bigger drivers of that, as it relates specifically to timberland at least, is that early period of very strong performance. When we looked at one of the charts with the historical time periods, it was really that period of time when timberland saw outsized performance relative to other asset classes as it was emerging as an asset class, moving from corporate to institutional investment ownership, which was really reflective of an inefficiency in the market. And I think as we saw over time, the performance has moderated, and more recently it's been at a lower level due to the just the decline in the U.S. housing market and subsequent weak recovery. But we do feel that we're at a point now in the cycle which appears to be a turning point for the various reasons that Keith laid out. So I think our view would be that on a go-forward basis, that the basic thesis there around the Sharpe ratios will hold up, that both timberland and farmland performance will continue to be more attractive on a risk-adjusted basis due to what has been relatively stable and low volatility performance as compared to other asset classes. But Keith, feel free to jump in and add anything I may have missed.
Sure, Mike. And no, the points that you made in terms of the maturing of both the timberland and farmland asset classes really sort of has contributed to sort of the compression that we've seen in its return profile. But also putting that in a larger sort of investment context, we've seen that return compression not limited to timberland and farmland. That's definitely been something that is across asset classes. Another feature that really contributes to that strong Sharpe ratio performance is the really sort of the nature of the markets that timberland and farmland are really sort of servicing, those really basic human needs that really, and to a certain extent, really guarantee that very consistent cash yield that they're generating on an annual basis. And in the case of timberland, the fact that you have this accumulated biological growth element to it really does provide sort of a cushion to those total returns over longer periods of time. Like Mike said, that over the past decade and a half, post-global financial crisis, post the collapse in housing markets, not only in the U.S., but sort of globally leading up to the global financial crisis, that has been a particularly trying period for timberland. But we really are sort of approaching an inflection point and really looking at the sort of contribution, the potential contribution that timberland and farmland can be contributing to climate adaptation and mitigation really does suggest that we are looking at some paradigm change moving forward. Thank you, Philip.
Thank you, Keith. Thank you, Michael. Thank you for answering all the questions. And of course, also thank you for the discussion and the great presentation. I can see no further questions. So thanks, ladies and gentlemen, for tuning in today. I am looking forward to welcome you back tomorrow and also on Thursday, our next webinar on trade finance on Thursday. So see you there and have a great afternoon. Thank you.
Thank you.
Thank you. My pleasure.